Hey there, welcome to the part 6 of our online course. In this session, we are going to understand position sizing. So in the last video, we understood what risk management is, and in this video, we are going to understand its second part. Basically, position sizing and risk management go hand in hand because without risk management, position sizing is incomplete, and without position sizing, risk management is incomplete. So basically, they are twin brothers of the same thing. But I did not wanted you guys to get confused on topics and all those things getting together, so I thought to put this thing differently. All right, so today we have position sizing. But before we understand position sizing, I want to clear a concept called drawdown. You must not be familiar with what drawdown means, so let's understand drawdown first and then let's head to understand position sizing because drawdown is basically an concept of risk management only. So I want to cover it before we get into position sizing. All right, so it is a very simple concept. What is drawdown? Drawdown basically means the literal drawdown on your capital in terms of percentage when you take a hit. Like if you invest 1 lakh rupees, let's suppose your capital is 1 lakh rupees and then you invest your 1 lakh rupees into different kinds of stocks. And then if that 1 lakh rupees comes down to 97,000 rupees, then that means you are taking a hit of 3%, and that is what we call a drawdown. Okay, let's take another example. Like let's take the example of 1 lakh only, but let's see now your drawdown is 50%. Meaning if you invested 1 lakh rupees into stocks, commodities, assets, Bitcoin, etc. And now current value of that portfolio is down to 50,000 rupees. What does this mean? This means that your current portfolio is at 50% drawdown. There is nothing complicated, isn't it? You just have to calculate the percentage terms by which your portfolio is down. And that percentage is what we call drawdown. So like on a capital of 1 lakh, if you go 10,000 negative, that would be a 10% drawdown. Now the thing about drawdown is like whenever you go 50% down on your portfolio, you need to make 100% on the same portfolio to come back to your original levels. Meaning this that if you go 50,000 negative on a 1 lakh capital, meaning your portfolio is down 50%. But now if you want to go to 1 lakh from 50,000, 50% is not going to be enough. Just because you lost 50%, if you gain 50% now, it won't take you to this original capital. So from now 50% drawdown, you will have to gain 100% profit to go back to your original level. See, from 50,000, if you go 50%, it would be somewhere 75,000. So to reach to your original capital, you need to have, you need to make 50,000 of profit more on 50,000 of capital, which is 100% return. All right, so this is where stuff gets nasty. This drawdown thing is very nasty, very rough. It kills so many people because we feel that okay, my portfolio is down 10%. So when I make 10%, I'll be back to original levels. But no, when your portfolio is down 10%, you will have to make more than 10% to go back to your original levels. Like when you invest 1 lakh and your capital is down to 90,000, that is a 10% drawdown. A 10% return on 90,000 would mean you will reach to 99,000. So you would have to get 11% return now. Getting it? So this is what a drawdown is. Let's go to the chart of drawdown in terms of percentage. It is available on internet and let's see there. All right, so here is the chart of drawdown in terms of percentage. So when you go 5% down on your portfolio, you need to make 5.3% to get back to the original level, to get back to even. When you go 10%, as we just saw, a 10% drawdown will mean you will have to make 11.1% to get back to your original level, to get back to your even. A 25% drawdown will mean you will have to gain 33.3%. A 50% drawdown will mean you will have to gain 100%, and so on and so forth. So as you go down this chart, this is a basically rabbit hole that keeps on going down, and the higher the drawdown percentage is, the the harder it is to come out of that rabbit hole. Because as you can see, on a 90% drawdown, you need to make 900% return on your capital to get back to even. Like, let's understand this. If you invest 1 lakh rupees, and now after 2 years or 3 years it's down to 10,000 rupees, so making so now you are like 90% down on your portfolio. So making 90% will barely get you to 19,000. 90% on 10k capital is 9,000. So it will barely get you to 10 plus 9,000, that is 19k. To get back to 1 lakh, you will need to have a return of 900%, that is 90,000. So this is how it actually works. This drawdown thing, we do not really focus on drawdown, but this is very, very difficult to handle when it goes against us. It is a very nasty thing. So what we can do is the only thing we can control is to not not let our capital slip into this drawdown zone. And that is so very important, because once the capital starts to go below 10%, 15% drawdown, it really becomes difficult to gain those original numbers which you had before drawdown. Like until 10%, it's still okay, because when you're down 10%, you only need to make 11.1. But now, as you start to slip lower and lower, it becomes very difficult to come back to those levels. Like a 15% drop down will mean 17.6. This is still fine, only a 2.5% rise, you would say. But now, if you see 20%, it's 25. For 25, it's 33. For 30, it's 43, and so on and so forth. So the only thing we need to take care of is to not let our capital go into drawdown zone. And how do we do that? How do we prevent drawdown? So we are not investors, we are talking about trading. But even in trading, drawdowns can happen. Like on a capital of 1 lakh, if you take a hit of 5,000, that's a 5% drawdown. Think about it. If you take a hit of 10,000 in any particular trade or over a month, it's a 10% drawdown. So if you lose 10,000 on a week, on a monthly basis or a weekly basis, you are getting a hit of 10% on your capital. So that is also a drawdown only. You don't need to be an investor to take a hit from drawdown. So this is the problem when it comes to trading and learning, because when you are learning, you are bound to lose money. But while losing money, you need to take care of that you are not losing too much, because if you go into that drawdown zone of 20-30%, then it becomes really difficult to come back to the even zone. So what can we do to avoid this? Now see, we have to accept the fact that in our learning phase we are going to lose some money. All right. And without losing money, we are not going to get experience. Experience is never going to come from good times. What is experience? Experience is basically what bad time teaches you. That is what we call experience, na? So to get that experience, you will have to face some losses and some heat from market. And eventually that experience will help you later on so much that you can't even imagine. But to get that experience, you need to face some heat and some losses. Fine, we accept that we are ready to lose, but how much? How much should we lose? Like, should we lose 10% in a day or 20% in a day? No. This is where we need to discipline ourselves, and we need to have a strict uh, kind of discipline with our mind, that no matter what happens, we are not going to lose more than 3% on one day. This is also a very big number, to be very honest. But on a smaller capital, because I am assuming you guys are having smaller capital like 1 or 2 lakhs, 3% is still manageable. I would rather say 1%, but because we are risking 1% on one particular trade, just because one trade went wrong, you would not be allowed to trade by that logic. So I do not want to that to happen. So let's not go very strict on ourselves. But the thing is, you need to take those quality trades. Like uh, uh, the quality trading thing needs to be there. Just randomly punching trades, if you're doing that, then that is going to be difficult. So we need to train our mind to be disciplined with this number of 3%. Like if you are risking 1% on a one particular trade and you get three continuous wrong trades for a day, then no matter how good the fourth trade is, you're not going to take it. Because who decides what is a good trade or what is a bad trade? It is we who decide. Market doesn't tell us that this is going to perform or this is not going to perform. It is just our emotions that tell us that this is a good trade or this is a bad trade. Emotions, I am saying, because as a beginner, you focus on emotions rather than your technical analysis knowledge. Professionals do not keep their emotions in them while trading, they keep it aside and make decisions purely based on what market is telling. But as a beginner, what mistakes we do is we analyze markets from an emotional point of view. So that is fine. You will learn all these things over time. There's that's what we call experience. That cannot be taught, but it's all right. So we are going to lose, but we have to keep a check on what we are losing. So even if we lose three trades in a day continuously, no matter how good a trade is, no matter your friend is telling you that this is going to run, no matter operator is calling you home and saying that, hey, buy this particular stock, this is going to run, do not do it. All right. So 3% drawdown is what we are going to restrict ourselves at. So no matter what happens, you're not going to take a hit of more than 3000 rupees on a capital of 1 lakh. If you have a capital of 2 lakh, this number will be 6000. If you have a capital of 50,000, this number will be 1500 rupees. So depending on your capital, calculate 3% of it and restrict yourself to not let or not get slipped below that number on a daily basis. Like this is a one time scenario. Like you are not going to lose three trades in a row on a daily basis. If you're doing that, then you need to make sure that you're doing analysis right, because that might be the problem, that you're doing some wrong analysis while trading in the markets. Because a 3% drawdown on a daily basis would mean you're doing something wrong with technicals. So get a grip on technicals. This is going to happen once in a blue moon, like once in 2 months, once in 3 months. But whenever this happens, you need to make sure that you are restricting yourself to 3%. Because what happens is, when you start to lose money, you start to feel angry and frustrated. And now, when you lose more, you want that money to come back to you again. And in that search of uh, taking money back from market, you trade even more. That is the problem of over trading. We will discuss over trading and all these problems in upcoming session. But yes, just giving you a glimpse of what usually happens. We overtrade markets, we lose even more, then we try to overtrade again, then we lose even more, and then we are frustrated that, oh my God, what did I do? I just blew up my account in one single day. So to avoid that, we have to keep this restriction for ourselves. Remember, Rome wasn't built in one day, but Hiroshima and Nagasaki were destroyed in one single day. Trading is not very much different. It takes years of hard work and consistency and practice to make a good portfolio, and it does not take even a one complete day to just blow off that account. So this is how trading operates, and that is why you need to be very disciplined in terms of all these things. So now that you understand drawdown, let's understand position sizing. So what exactly is position sizing? Position sizing is basically how much quantity you should trade. Like I like to keep things simple. I do not want to complicate things. So let's start in simple language. Position sizing basically means how much quantity should you trade. Like you have capital of x thousand or x lakh, and now you are confused that, okay, risk management to सीख लिया मैंने, I understood risk management, but how am I going to define quantities? How am I going to define my risk without even knowing what quantities am I going to punch? All right, so there's a formula, a simple formula for understanding position sizing. So position sizing का formula ये है, the formula for position sizing is risk appetite divided by your stop loss. We will understand this with multiple examples until you get a hold of what and how to calculate position sizing. All right. So this is the formula: risk appetite divided by stop loss. What is risk appetite? Risk appetite is basically the risk that we are going to take on per trade basis. So in the last video we discussed we are not going to take more than 1%. So this is risk appetite. So risk appetite is going to be 1% of our capital, and then we have our stop loss. So now let's take an example. Let's say you want to buy Tata Steel. You want to buy, for example purposes also, we are going to keep that capital, our capital as 1 lakh. So as our capital is 1 lakh, our risk is going to be 1%, which is 1000 rupees. So you want to buy Tata Steel at 1505. All right. This is an example. This is how we calculate in real life when the markets are open. So you want to buy Tata Steel at 1505. Your stop loss. Your stop loss is, let's say, you decided based on your technical analysis that 1500 is going to be your stop loss. So how do we decide what is the quantity? Now you know that you have only 1000 rupees to risk, but how are we going to define the quantity? So to understand that, let's put the values in this formula, and then we will have our position sizing. So what is your risk appetite in this particular case? Your risk appetite is 1%, which is what? Which is 1000 rupees, right? And then you have your stop loss. What is your stop loss? Your stop loss is 5 rupees divided by 5, right? How 5? 1505 minus your stop loss level. So your buying level minus your stop loss level. So that is the number we get. So 5 rupees stop loss. 1000 divided by 5, what is that? It is going to be 200. So 200 is what? The number of quantity that you would be punching for buying Tata Steel at 1505, stop loss at 1500, and when your capital is 1 lakh rupees. Why? What is the logic? I call this answer, this calculation, this final number as MTQ, meaning maximum tradable quantity. Maximum tradable quantity, meaning you should not go beyond this number when you're taking this particular position with this particular capital with this particular stop loss. Why? What happens is when if your stop loss gets hit on a 200 quantity, you are not going to lose more than 1% of your capital. 200 multiplied by 5 is going to be 1000. So you're not going to lose more than 1% of your capital in this particular scenario. So I hope you're getting it. Let's see another example. For example purpose, again, we are going to keep our capital as 1 lakh. So the risk is going to be 1000. Now you want to buy, let's say SBI at, let's say 400 levels. Buy SBI at 400 levels. Your stop loss with the help of your technical analysis and all that is 398. So your stop loss is 398. So how are we going to define the quantity, the maximum tradable quantity? We are going to divide risk appetite by our stop loss. So what is stop loss in this case? You guys tell me. Yes, it's 2 rupees. 400 minus 398. So our buying price minus stop loss, that is 2 rupees. So this is where you get your MTQ. So MTQ meaning the maximum tradable quantity is 500. Why 500? Because on a 500 quantity thing, if your stop loss of 2 rupees gets hit, you're not losing more than 1000 rupees, which is 1% of your capital. So you will only take a hit of 1000 only. So this is the logic behind position sizing. All right. This is how position sizing operates. Let's now take one more example. Let's say you want to short now. Let's take a short side example. So let's say you want to short Tata Motors, okay, at let's say 293. All right, your stop loss, let's say, is 293.50. You have a very tight stop loss. According to you, it is enough, and now your stop loss is very small. How are we going to define the quantity? Again, same thing, risk appetite divided by stop loss, isn't it? Getting the point? Yes. So 1000 divided by 0.5 is going to be what? 2000. So 2000 is going to be your maximum tradable quantity. Now the thing is, when you keep small stop loss, you get to have a bigger quantity. Whenever your stop loss is big, like if it was 295, then the quantity would have been 500, like this. But when you keep smaller stop loss, you get to trade more quantity. So what am I trying to say? Keep smaller stop loss? No. It is not about keeping smaller stop loss. It is about rather tweaking your entries in a better way, in a point where the stop loss is minimum. Rather than making some random entries, wait for that particular trade to hit a particular point where the risk is minimum. So what happens is, that way you can keep a very small stop loss, and then your maximum tradable quantity will be higher. And what happens is, when your maximum tradable quantity is higher, your small moves can make you big money. Like a 1 rupee movement on 293, from 293 to 292 will make you 2000 rupees. But if your stop loss was 295 and your quantity was 500, the same 1 rupee movement is going to make you 500 rupees. So this is the thing, that you have to be patient while entering the trade, and enter the trade where the risk is very minimum, and place aggressive stop loss. So that will help you amplify your returns and grow your capital even faster. Now let's take an example of Nifty. So this was cash market. Let's see how you can do position sizing in Nifty. So same example, 1 lakh capital. All right. So the lot size of Nifty for now is 50. Earlier it used to be 75, but now the lot size is changed. It is 50. So let's say you want to buy Nifty. The current price is somewhere around 17,200. So you want to buy Nifty. Now this is technically not possible because of the SEBI rules that are there, because it won't allow you to buy Nifty futures in 1 lakh rupees. But whatever, this is just an example. All right. So let's say you want to, let's rather than option futures, will see the position sizing on options, in my opinion, because futures are not going to be, you will not be able to trade futures in that capital anyway. So understand, because futures, the thing of position sizing of futures is pretty similar to what we did in the cash. It is difficult for options to understand. So let's understand position sizing for options. So let's say you want to buy Nifty 17,200 call, which is trading at, let's say, 65 rupees. Your stop loss is, let's say, 50 rupees. Now this is options. So you have to consider the lot size and everything. So lot size is as of now 50. So you have to again put the same formula. Like, what is the risk? Risk here is 15 points. All right. So let's take our risk, divide by stop loss, which is 15. So 1000 divided by 15 is going to be 66. Now what does this mean? 66 is basically the total quantity it is displaying that you can buy. Now you have to divide this number by your lot size. Divide by 50, because that is what our lot size is. Isn't it? Getting the point? So it is going to be 66 divided by 50, which is 1.32. Now this means that you can buy only 1.32 lots. Now decimal cannot be the decimal is not considered when you are trading in options, so you have to buy one lot. All right. 15 points stop loss and a lot size of 50, meaning on every tick you are going to make or lose 50 rupees. So 15 multiplied by 50 is going to be 750. So the risk on this particular your trade is going to be 750 rupees. Now you will say, hey, that's not even 1%. I'm losing my potential, full potential of taking the full advantage of that trade. But no, because these are options, it becomes a bit tricky to manage your positions. Now instead of this 1.32, let's say it was 1.8, so you might say, okay, let me go to directly two lots. But no, don't do that, because even if the decimal is 1.9, you have to stick to this particular thing, because a 1.9% will not mean that you have to go to two lots, because that will increase your risk from 1% to, let's say, somewhere around 1.1 or 1.2%. Now that won't make any difference on a smaller capital, to be very honest, but it will it will create a bad habit, that to break your own rules kind of thing. So that bad habit will kill you over time. So it is always good to follow your habit. Even if this number comes to 1.99, stick to one lot only. So you have to completely ignore the decimal and go with the whole number that is there. Let's see another example on Nifty only. So let's say you want to buy 17,100 put at, let's say it's trading at 28 rupees. All right. Your stop loss is, let's say, 24 rupees. So how are we going to calculate? We are going to calculate 1000 divide by, what is our stop loss? Our stop loss is 4 rupees. So 1000 divided by 4. 1000 divided by 4 is going to be 250. And now 250, you have to divide this number 250 by your lot size, which is 50. So which is going to be what? 5, isn't it? 250 divided by 5 is going to be, so 250 divided by 50 is going to be 5, which means this is the maximum number of lots you can take on your capital. Because on 5 lots, if you lose this on this particular trade, you will not lose more than 1000 rupees. That is how the thing is. That is the calculation. So I hope you are getting the concept. If you have any doubt, please free to rewind this video and watch it again, because it is pretty simple, but it is very important. If you miss out on drawdown or position sizing, it will become very difficult to trade in the real market scenario, because real markets are fast and furious, and if you're not managing your risk and positions, then it can literally blow your account in just a couple of days. So make sure to understand risk management, drawdown, and position sizing completely before proceeding, because in the next session we are going to understand a method of personalizing risk management. Like, what is personalized risk management? Let's say someone is having an accuracy of 30%, and on the other hand, someone is having an accuracy of 60%. Now, is it okay for both of these to risk 1%? Because guy with 30% accuracy is going to lose much more than the guy with 60% accuracy. So what should we do? In this case, we can personalize our risk management in such a way that the guy who is having 30% accuracy can risk according to his accuracy and lose a lot less than what he is losing. And the guy with 60% accuracy who is doing good in markets can risk a bit more according to his accuracy and make use of the potential of the markets and make more money. So that is how we understand personalized risk management. There is going to be uh, a formula for it, and it is derived from Kelly's Criterion formula. So, but it is going to be a very interesting session. So, it is going to be fun. But before understanding personalized risk management, I want you guys to completely understand risk management, drawdown, and position sizing, because all of these three things are going to be a part of next session. So, I will see you in the next session. And until then, you guys take care. Bye bye. Peace out.